You are evaluating the creditworthiness of TechLink, a fast-growing electronics wholesaler. TechLink's balance sheet shows significant revenue growth over the past 3 years. However, further due diligence suggests accounts receivables have grown faster than sales, and the majority of its receivables are concentrated in 3 large customers. TechLink requests a working capital loan from the bank at which you work. Now let's look at part 1. What procedures and ratios would you employ to evaluate the sustainability of receivables in relation to revenue growth? Firstly, I would compare the growth rate of accounts receivable with the growth rate of revenue. Ideally, these two should be growing together. Since receivables are growing faster than sales, it can signal several potential issues. First, TechLink may have loosened its credit terms, meaning customers may have longer to pay or it's become easier to buy on credit. Second, it could indicate slower collections, where customers are simply taking longer than expected to settle their invoices. And third, in the more serious case, it could point to revenue recognition risk, where sales might be recorded too early without an increase in cash collections. So this comparison helps us judge whether growth is healthy or whether cash collection is starting to lag behind reported performance. The second ratio I would use is the accounts receivable turnover ratio, which measures how efficiently TechLink is collecting cash from its customers. It's calculated as net credit sales divided by average accounts receivable. A higher turnover means receivables are being collected quickly, which is positive for liquidity. However, if this ratio is declining over time, it suggests weaker collection discipline, meaning the company is taking longer to convert sales into cash. Closely related to turnover is days sales outstanding, or DSO, which shows the average number of days TechLink takes to collect cash from customers. DSO is calculated by accounts receivable divided by average daily sales. A rising DSO means cash is tied up for longer periods, which puts pressure on liquidity and increases the need for external financing, such as a working capital loan. I would also compare TechLink's DSO to industry averages to see whether their collection performance is in line with competitors or whether it is underperforming. Now let's move on to the second part of the question, which looks at the risks of having a highly concentrated customer base. A concentrated customer base creates dependency risk, which can significantly affect a firm's liquidity. First, there is customer default risk. If even one major customer delays or fails to pay, the company could face an immediate cash shortfall. Second, there is bargaining power risk. Large customers often push for longer payment terms or discounts, which increases DSO and delays cash inflows. And third, there is revenue volatility risk. Losing a key customer could cause a sharp drop in revenue and cash flow, making the company more reliant on bank financing. Together, these risks increase uncertainty around TechLink's ability to meet its short-term obligations. To complete the credit risk assessment, I would request 3 main categories of additional information. First, I will ask for detailed customer information on the top 3 customers, including their credit quality, contract terms, and historical payment behavior. This helps assess counterparty risk and how exposed TechLink is to a small number of customers. Second, I would review receivables quality and aging, including an aging schedule, historical bad debt write-offs, and the company's provisioning policy. This helps determine whether the receivables on the balance sheet are realistically collectible or potentially overstated. Third, I would assess TechLink's credit policy and controls, such as how customers are approved for credit, how collections are handled, and whether there have been recent changes to credit terms. This information will allow me to judge whether the growth in receivables reflects healthy business expansion or increasing liquidity risk. And now, moving my time on to Jonathan.